Excellent. So I'm here with Richard Brown, the CTO of R3. And for those of our listeners who don't know what R3 is, what is R3?
So R3, we're a consortium of over 75 of the world's largest financial institutions. I guess we first came to prominence in September last year in 2015 when we announced our first members. We grew to 42 members in November last year, and we now have over 75. And we have quite a simple mission. It's to understand, apply, and develop blockchain technology in the financial markets, financial services arena.
Very, very cool. And about yourself, Richard, did you ever think you'd end up where you are? And how did you end up being CTO of R3? And what was your journey?
Yeah, I asked myself that quite a lot. So until I joined R3, I was an IBM lifer. So I'd worked in IBM since I graduated from university. So I guess like many people, you go to university, you don't quite know what you want to do. So I studied mathematics. I realized I quite liked it at university, so I stayed for an extra year and studied computer science after I graduated, and then joined IBM as an engineer. And what I realized quite quickly was that engineering was very interesting. I enjoyed working on software products. It was primarily middleware, getting computers to talk to each other, moving data around the world. But I had no idea why anybody bought this stuff or who the customers were. And I thought, actually, I need to get out there and not just be sitting in the lab in this amazing facility in the countryside in Winchester. So I worked through a variety of roles in IBM in consulting and in engineering, as I described, and in pre-sales, actually going out and explaining how this stuff works to customers, but almost always focusing on financial markets, financial services, and banking. And then I guess probably about 3 or 4 years ago now, I came across this thing called Bitcoin. It was just like a one paragraph description in The Economist of all places that talked about this strange new virtual currency. And it piqued my interest, and I read up about it, read the white paper, downloaded it and played with it, and didn't really think much more about it. It appealed to my instincts. It was I was interested in economics and finance and politics. So I had to play with it and then put it to one side. And it was only really a year or so later, so I guess 3 or 4 years ago now, that it really came to prominence. There was a huge amount of talk about it in the news. And it just occurred to me that all the technologists who were talking about it really didn't understand banking. So all these ideas they had about how it was going to destroy banks or change the world, I thought that just doesn't make any sense. And all the people who were petrified by it and thought it was the worst thing ever didn't really understand the technology. So I started writing about it, and I just started engaging because it was relevant to IBM, it was relevant to our clients, and I just got more and more down the rabbit hole, realizing that actually it's the underlying technology, it was the blockchain, not Bitcoin, that could be relevant to finance. And then the light bulb moment for me, and I guess this gets us back full circle to R3, was it occurred to me, as it did to our founder David Rutter at R3, it occurred to me that if this technology, if this underlying blockchain technology is going to get deployed in finance, or in any industry for that matter, it will have to be done by multiple firms working together and multiple firms working together at once. And therefore, when R3 came to prominence and it was clear that David, our CEO, had managed to pull together this astonishing consortium of banks, I jumped at the opportunity to join as CTO.
That's a heck of a story. Really good though. And it begs the question then, if you really cared about blockchain and DLT, why should anybody care about it? Like if I'm in a bank or I work for a bank, or even if I'm just somebody who's interested in the area.
So we wrestled with that for a really long time when we kicked off the consortium, because it would have been so easy, if you had, as we did at the end of November last year, we had 42 of the world's largest banks, and me as the head of the technology team, as the guy who was running this thing we call the Architecture Working Group, which is this body formed of tens, originally now hundreds of really senior technologists and architects from all our member banks. It would have been so easy to say, it's our mission to take all the technologies are given and let's just apply it to banking. Let's apply blockchain to banking. Let's apply distributed ledgers to finance. But we thought, well, no, we have this. I felt this weight of responsibility. We have these institutions who are working with us and who are ultimately paying our bills. We need to do better than that. We need to do some real engineering and some real thinking. So we spent, as I say, considerable time at the end of last year saying, what if anything is new or different about this technology? It's not often that there is a breakthrough in computer science. There are waves of hype all the time, but it's not often that there's something new. So let's be really precise about what is new here and what's different. And we came to the conclusion, and it doesn't sound profound, but genuinely it is. We came to the conclusion that what is new about this space, about blockchain and distributed ledgers, is for the first time we can now build systems, computer systems, technologies that are run between different organizations who don't trust each other, yet allow them to come to consensus, allow them to agree and know they agree about the existence, the nature, and the evolution of some shared facts, some shared data. In the Bitcoin case, it was just how many Bitcoins are there and who owns them and who's allowed to spend them. But there are other platforms. There's Ethereum, and what they're interested in is completely different. It's a state of, it's quite technical. It's the state of a virtual computer. But what we realized and what has formed the basis of our work is actually this idea of having organizations who don't fully trust each other. I can see them here. We're doing this podcast in Canary Wharf. I can see I can see about 4 different banks out of the window, and they trade with each other. They trust each other enough to lend each other money or to enter into deals. But they don't trust each other to maintain their books and records. They maintain their own books and records. So if we look at this technology that allows people who don't fully trust each other to come to consensus about some facts, it just becomes self-evident that there's a massive opportunity now in finance wherever firms record the same data that their peers do, that their counterparts do, and then have to manage it. This blockchain technology, this distributed ledger technology can be used to massively simplify and reduce that cost and complexity by just doing it once and knowing for sure that what you see is what your counterpart sees.
But if I'm just doing it once, surely I centralize everything. Surely that's the answer to all the world's ills.
Well, sure. that is a perfectly legitimate and honourable approach. You look at, imagine 5, 10, 20, 50 years ago. In fact, even go back to the 1960s and 70s, with the famous Wall Street paper crisis, the paperwork crisis. You could argue there was a similar thing then. What was the problem back then? The growth. There's been a massive growth in share trading. The brokerages and the various firms involved just couldn't move the share certificates around between each other fast enough. And the solution they came up with was, let's build some centralized infrastructure. What ultimately became the DTCC, the Depository Trust and Clearing Corporation. Let's build some central infrastructure. We will put all the paper in that, all the share certificates in that organization. They can keep track of it for us all. And that works pretty well. It works brilliantly, in fact. And that solved the paperwork crisis. And that's been the recurring theme in finance for decades now. If you get to a point where there's just too much complexity or too much risk, we'll create a central infrastructure. And that's often the right approach. What distributed ledgers and blockchain is showing us is that actually, if you don't, for risk purposes or regulatory purposes, need to create a new central infrastructure, but you still do need to get the benefits of knowing that the data is consistent and is accurate, you can do it through a technological solution, through distributed ledgers, so that you know that your system is in sync with your peers without having to go and create yet another central institution.
That's a really well put point. And I guess, why is that exciting, I guess? So is there a real benefit to this for the banks?
Well, I guess, and maybe this sounds trite, but the real reason for doing this isn't to be nice to the banks or to be good for the banks. It's because ultimately everything any corporation does is ultimately paid for by their customers. So again, I'm looking out of this window and looking over Simon's shoulder, and I can see lights on from floor 1 to floor 30 of the bank that's sitting behind him, and a huge amount of the work that goes on there. Therefore, the cost, the complexity, the risk, the duplication, the error is caused by people whose job essentially, and by systems whose jobs essentially, are to check that all the information that sits inside that tower block is in sync with the data that sits in the tower block next door. Who pays for that? The customers pay for that.
So on that note, how is Corda different? How is Corda different from traditional blockchains? Is this something that, if I get a academic come and tell me what Bitcoin is, do I understand what Corda is, or is this very, very different?
Actually, ironically, Corda is actually in places quite similar in philosophy to the underlying design of Bitcoin in some ways, but it is in general very different to some of the blockchain platforms. So maybe the way to think about that is to go back to the early days of the work we've been doing. I went back to our records over the weekend because I was sending a note to our development team to thank them for all their work to date and to encourage them for the next few weeks as we get ready to open source Corda, our distributed ledger platform. And I went back into our source code control system and I looked to see the very first commit. I went back page after page, and I think there were 85 pages of commits. And the very first one was from November the 3rd, 2015. So it's almost a year since we started work on it. And work began about 5 or 6 weeks after the architecture working group of R3 was instituted. And the reason we began work on it was because we'd been studying blockchain systems. We'd come to the conclusion that they're all about bringing parties who don't fully trust each other into consensus about some shared facts. And we'd gone further and we'd said one of the key reasons this could be relevant is because banks are almost defined by the shared facts they have with their peers, the contracts, the agreements, the trades, the deals, and so forth. And it seems that if you could get to a point where those deals and those trades and those records were in sync with your peers, you could take out so much risk, cost, complexity. But then when you look at the technology that has inspired all this, the thing that actually got us through that logical journey, it wasn't designed to solve the problems of banks. The Satoshi Nakamoto, when he invented Bitcoin, he didn't wake up thinking, I want a blockchain. And 2, he didn't wake up thinking, I want to solve the problems of the world's investment banks. That wasn't what motivated him. So it would be unusual and a bit surprising if those technologies that were not designed for this happened to be the perfect solutions. And when you look at them, they were hugely inspirational, and they showed us that it was possible to build these systems that bring banks into consensus with each other. But they have a design they're designed for different problems. So in general, they're designed in a way that requires all data to be processed by all peers. So if you think about that, you think, okay, you and I have entered into a deal, you've lent me some money, and suddenly we send a copy of that to all our friends and everybody who knows us. And we ask all our friends and everybody who knows us to validate that information. And we ask them all to vote on whether it should be processed. We need that for some public blockchain systems like Bitcoin and Ethereum, but that's not how finance works, and it doesn't solve our problem. The idea that private information would be shared with everybody and everybody would process it kind of doesn't make sense. So Corda really came from a thought experiment that said, how do we build a system that gets these benefits of consensus, allows us to manage and automate deals between different financial institutions, but how do we do that in a way that doesn't leak data everywhere, doesn't run at the speed of the slowest computer, doesn't require everybody to validate everybody else's transactions if they shouldn't. And we started simulating. We worked with all our members who gave us a lot of input to the design. They were governing the work we were doing. The simulation graduated into prototyping, and then in about March or April this year, we believed Corda was reaching the point where actually this is a thing. This thing is genuinely different to what other platforms are. It's not a me too. This is a contribution to what the world's doing. So we announced it. We demonstrated actually with Barclays, who actually are one of the towers I can see behind your shoulder. We demonstrated in public that this Corda thing actually has value and it works, and we said it will be open sourced, which it will be on November the 30th. But in the short answer to your question is, how is it different? It is designed by and for financial institutions. Its focus is not on cryptocurrency or virtual machines. Its focus is managing legal agreements between regulated institutions. It's designed to integrate and interoperate with existing systems in banks. And as I say, it's designed to integrate well with the legal system. These contracts, these things we're managing on the platform. In the event of dispute, there has to be a way to resolve them and to enforce them. So this isn't the idea of computers running amok and controlling the world. This is computer code. This is computer data that, in the event of dispute, is grounded firmly in legal reality.
So is it fair to say this isn't a silver bullet that fixes all of the world's ills and all of the bank's ills? It's really quite targeted at, as you say, dealing with financial agreements and how we come to consensus on the state of those financial agreements. So is it very targeted around that, or will it solve for settlement and all the other things in post-trade too? What's the scope here? Is it just that piece?
That's a really good question. So is it the solution to all the world's ills? Strange. No, it's not. That was and be very suspicious of anyone who claims that what they're building is. But it's been quite interesting how it's developed. So we were very precise. I think we were very precise in how we scoped the design. We said we think the problem, or one of the problems to be solved, as you say, is managing agreements between financial institutions. So to drive the design, we said, almost as we call them the architecturally significant use cases. We said this platform needs to be able to model the idea of on-ledger cash, the idea that I can manage a bank, I can represent a bank balance that can be transferred reliably and regulatorily satisfactorily. I need to be able to represent a security. So we used a corporate bond as an example, and it needs to be able to represent a derivative instrument, and we chose a credit default swap because it also has insurance characteristics. And they seem quite diverse, but they're also quite constrained. And the design of Corda was intended to be able to address, in principle, those three use cases. It turns out that once we'd built something that could address the bulk of those requirements, that it turned out that this actually turns out to be quite useful for finance, but it's more useful generally, this idea of representing a contract between two or more parties and evolving it and linking it to legal prose. That's not just relevant to finance. And it's actually one of the reasons we're open sourcing it, so that we have our vision for how it will be deployed in finance, but it's applicable elsewhere, and we're looking forward to a much broader community contributing to it.
Very, very interesting indeed. And one of the things I know you and I have talked about previously is this idea that will we be getting rid of all of banks' systems and all of banks' knowledge and everything we knew before because now a distributed ledger exists? Or do we need complementary technologies still? Do we still need to think about cloud? Do we still need to think about other technologies in there like Java and JVMs and other bits to it? Or is there this new distributed ledger thing? What's your position on that?
It's I guess it's additive. This is not going to replace everything. I mean, even if banks deploy distributed ledgers wholesale and for all their operations, you still need to report. You still need to be able to back it up. You still need to move data around internally. There are huge numbers of things. You still need email. There's still a huge amount of things that the world needs to do. But we did, and I guess maybe this is where you were going with your question. We did think very hard about what we needed to invent and what we could reuse. So if you look at, and there are valid reasons for this, but you look at some blockchain platforms, they've taken an approach where they've reinvented everything from scratch, their own tools, their own virtual machines, their own languages. Everything from top to bottom has been rebuilt from scratch. And that's very interesting, and it has some value, but it's also very expensive and imposes a big burden on the teams supporting it. What we did with Corda was we said what is the essence of what needs to be built, this consensus layer, this layer that can represent agreements. That's where we'll focus. But actually moving the data around, well, you know what, there's messaging systems for that. Actually storing the data, there's already existing databases. Actually running the business logic, well, the Java virtual machine's been around for 20 years. Why don't we use that? There's some work we have to do to make it deterministic. We need to make sure that if I run a calculation and you run a calculation, we both get the same answer. So guess what? We've done some work just on that bit of the Java virtual machine, and we'll be open sourcing that. But if I look at the dependencies for our code base, there's a large amount of code we've written, and the last time I checked it, I think there are 55 open source projects that we also depend on. There's a huge amount of reuse.
That's incredible, and I think it's something that's often missed in this whole blockchain space. People see the hype. People see a lot of things where blockchain is going to change the world, but actually the vision you're giving me is a very sober, very sort of targeted view as to where you believe Corda is going to help financial markets in the near future. So Richard, I want to thank you for joining me today. Where can people find out more about R3 and the work you guys are doing?
R3.com.
Thank you very much.
Thank you, Simon.